Good morning, everybody. It is me, the Millennial Investor 1914. Welcome back to my channel. Yes, you guys know I am here to deliver that fire. I got this, I got that. You guys already know I'm coming. I'm bringing that energy. I got a good topic today. I'm excited. I've been away. I got a haircut, and man, let's get to it. Let's talk about it. You guys already know we always talk about let's get this money, how to get this money in the stock market for the long haul, short term, long term investor. I'm here for it. A lot of times it's a lot hard trying to come up with different topics that's not redundant, that a lot of people probably haven't gone over. Some thought provoking topics for individuals my age group, 35 and older, and even individuals who are 18 who just started, who's working into who just started working and just now is in the market. I try to come up with creative ways just to bring value and give value for you guys. Today's video is going to be about retirement planning strategies for comparing the 4% rule versus dividend stocks. So we're going to go over, we're going to dive right into the video, and we're going to talk about why the 4% rule is important, what it is, how we effectively use the 4% rule in our everyday life. But then I'm also going to talk about, because we all know that I'm a dividend growth investor. I invest into dividend stocks. I invest into just many different portfolios, from a dividend growth portfolio, my Roth IRA, which have dividend stocks in it, and my regular IRA. And so I'm going to go over just let's just say the positives and the negatives, and which strategy is most important, which strategy is right for you, and basically why you should do it. So if you let's get into it. So let's talk about this 4% rule. So when you try to figure out retirement planning, the goal is to figure out how much retirement income you need. So uh, rather you are 25 years old, 30, 50, 60 years old, the goal is to amass enough wealth, and then basically figure out how much of the particular uh, wealth pot or honey pot or money pot that you can accumulate, and then divide and split it amongst the whole year to live off of. I'm just summarizing basically the whole 4% rule and basically saving for retirement. We try to basically amass enough shares to basically live off of on a monthly basis and yearly basis. And so where will your money come from? When you sit down with a wealth advisor, a retirement advisor, a CPA to look at your all of your portfolios to see if you are a financial advisor, to be able to see if you are close enough to retirement, what you need to do, if you need to save more. What they're gonna see is they're gonna look at all your different portfolios. They're gonna look at, do you have rental properties? Do you have how many houses or commercial properties do you have in your portfolio? Do you have crypto? They're going to see, okay, you've been on your job for 15, 30 years. Have you invested into your 401k? How many shares of said mutual fund or index fund A or B have you bought? And then over the span of the years, how much has it's grown? And so right here, the 4% rule versus dividend streams. Over here in this side of YouTube, in dividend growth investing, we preach to basically buy and create a dividend portfolio of stocks that's reliable, of companies that have been around, like Apple, Microsoft, McDonald's, Lowe's, Home Depot, Real to Income O. What else? Apple, if I haven't said Apple already, I'm sorry if I said it already. ExxonMobil, Chevron, companies like that has been around, that us as consumers that we're going to utilize regardless. Uh, basically, have a portfolio of 10 to 15 stocks, reinvesting the dividend, buying these stocks, and then having a portfolio that grows from $0 to 10,000, 100,000, 200,000, and then hopefully one day it's $1 million portfolio. Hopefully one day. That's the thought, right? So let's talk about the retirement strategy of the 4% rule. Everyone knows about the 4% rule. Even when you Google it, the 4% rule, it was published in 1994 by William Bengen. And so basically, Bengen devised what is the safe withdrawal rates. And so when you think about the 4% rule, think of it as you amass a portfolio of a said you have amassed a set amount of portfolio value. So let's say you've been buying mutual funds in your work 401k, and you got it up to due to you buying more shares on a per week basis, on a per monthly basis, and then also said portfolio grow. So let's say you've been investing in the S&P 500, and so you've been buying every 2 weeks, every monthly in your work 401k. You've been on your job for 15 plus years, and then also those shares have grown. Let's just say in the past 15 to 20 years, you now have a portfolio of 500,000. Now, right here, according to the Bengen safe withdrawal rates, now you have to figure out based upon your portfolio value how much of a withdrawal can you take out your portfolio on a yearly basis, which broken out into on a monthly basis, but on a yearly basis, on an annual basis, that's not going to harm your portfolio. So typically, the 4% rule is basically it's really like 3.5%, 4%. Now, if you due to certain research, they say that you can squeeze it and go as high as taking 5% out of your portfolio, because the theory you have this, but I'm gonna talk it through right here to summarize. Basically, the theory is that if you have a portfolio of about 500,000, the market is going to go up theoretically, if especially if we don't have any like recessionary periods and like a down year, the market typically goes up 10 to 12%. And so if you take 4 to 5% out of your portfolio on an annualized basis, you still have that cushion of the other, whatever 12% minus uh 4 or 5, so 9, 10, 11, 12. Yeah. So like you still got another 8 to 9% that your portfolio has grown, even though you've taken out 4.5% out of your portfolio. And so that's why they encourage for you to basically amass a large enough portfolio, and then to take roughly 4.5%, depending on how risky you want to get. You can push it up as 5%, but that's why they preach for the 4% to basically to continue to buy shares, let it grow, and hopefully have a portfolio of around 750,000 to around 800,000, because then you can be a little more risky in terms of wanting to take uh, like 5% out of your portfolio, right? And hold on, before I go, because I ain't want to go through this because it's boring. And but right here it says later studies have produced inconsistent results, but they are often close to the 4% original. At the extremes, I have seen studies that put the new rate as low as 1.7% and as high as 5%. Listen, I didn't even look at this beforehand, but yeah, the basically the SWR is whatever the safe withdrawal rate from your portfolio. So right here, it says the likelihood of success after 30 years. And so right here, it shows if you have a portfolio, so of between equities and bonds. Equities is stocks and then bonds. So if you had a portfolio of 95 to 100% equities, you can go as far as you can push your luck to have a withdrawal rate of 5% and have a 60 to 65% uh, success rate. And the success rate is basically understanding that right now, just like in this year alone, in 2023, we've had a lot of down days, and so a lot of people will say this year we've been in a bear market. Last year was we was in a bear market. We've been in a bear market for, I would say, for a little while now. Where in a bull market, the stock market is going up. Tech stocks is going up. Portfolios are going up and going up in numbers. You putting 10,000 in, and it's really it's making money. And so, but then it's moments like this year, or like these last couple months, where the market has been down a lot, 2%, 5%, and you feel hopeless. And so, a lot of times, if you talk to a financial advisor that plans people portfolios and to look at your risk management, they typically will take your money, and depending on how old you are, so the younger you are, the more you will be in stocks, equities. The older you are, so if you are in 50, 55, 60, 65, then what they tend to do is that they still will keep you in equities, but then they will sell some of your equities and put it into bonds, because bonds and treasuries, notes and whatnot, and U.S. Treasury bonds are a lot more safer. It doesn't increase, and it doesn't bounce up and down a lot like stocks and crypto. It's a lot more safer, and so right here it shows if you had a 80-20, where 80% in stocks, 20% in bonds, you can push it, uh, a withdrawal rate from your 4% portfolio, uh, around 4%, and you can still have the 85 to 90% success rate of your portfolio not defaulting, meaning that you take 4% out of your portfolio, so you have a 500,000 to that $800,000 portfolio that you've saved up, right? You're taking 4% out of it, and it shows right here that you have a 85 to 90% chance of succeeding. That even in down markets like right now, that you won't uh overstress and stress out your portfolio where you're going to be losing money. Now, if you were, as you move from right to left, the more bonds you have in your portfolio, the more you don't have stocks and equities to make up for that time. Which means that uh, if you try to take more, you are at risk of when a stock market goes down, to really feel it, and not to be able to bounce back. Sucks. And then here's right here, the annualized returns of a 60-40 portfolio, yada yada yada. And then we talk about living off dividends. And so living off dividends, it's a great strategy. But the thing is that uh, right here, so the returns of a dividend growers in this year's have a beta of 0.88, has generally produced a annualized return of 10.4% compared to a equally weighted portfolio in the SP 500 index of 7.68%. Uh, but comparing the two, uh, usually people are going to tell you, "Oh, do this. Just do the 4% rule, and just invest just only into your 401k, and that's fine. Or only just do dividend growth investing." And one of the cons and the negatives of why people don't like do dividend growth investing is because dividend growth investing, it takes time. It's slow investing. You have to have patience. You have to have patience. You have to have patience. Investing in general, you have to have patience. And being a dividend growth investor, you have to have patience, because it's small increments of growth compared to just growth investing, where you are investing in Nvidia and Tesla, Amazon, where in a day it can grow 50, 75%. I've seen Tesla uh, had a 50% increase on a day, but I've also seen Tesla have a 30%, a negative or minus 30% return on a day. And so invest into just growth stocks, high risk, high reward. Invest into crypto like Bitcoin and Ethereum, high risk and high reward. But it's always best to diversify your accounts, diversify your funds, diversify your stocks, diversify everything, everything. Invest to crypto, invest into Bitcoin, invest into actual physical gold, physical silver. Have money in your bank, but also have money outside the bank. And so here, invest into your 401k, into a mutual fund or an index fund, building that up so that in the future, 25 years, 30 years down the line, if you want to amass a portfolio of about 500 to 750,000 for you to implement the 4% rule, great, do that. But also create and implement a dividend growth portfolio, a dividend growth strategy. Why? Because as you go and you increasing your work 401k, you opening up a Roth IRA, right? And then you and putting money into your Roth IRA, and then you also creating a dividend growth portfolio, you are able to live off that portfolio. Let me walk you through it. I'm gonna walk you through it. So I'm gonna go through my example as I have one portfolio that's 15,000. So if me not touching that 15,000 at for 30 years, for it to increase and the interest rate for at 30%. No, for 30 years at 20%, 20%. And the reason why it's at 20% because I have a lot of high growth stocks like Intuit, Costco, Accenture, Visa. And so these stocks are high growth, high beta, high risk, high reward type stocks. And so if I just put 15,000, just let it work for 30 years. Boom. Let's just say that let's just say, because we know that future money is going to be a lot less than in present money because of inflation, and $100 right now is not worth $100 back then. So let's just say in 30 years from now, that $15,000 grow to 1.4 million. Now we know that 1.4 million is not going to be worth 1.4 million, but you can really right here, because I got my calculator. So 1.4, and let's just say you apply. I did 4.5, right? So basically, I'm able to take $63,000 on an annualized basis, and so that $63,000 is probably not going to be worth $63,000 in future value. That $63,000 is really probably going to be worth maybe, let's just be generous. Let's say $30,000, right? So I'm able to take out $63,000 per year, right? And so you have that going for yourself as an investor, and then you have Social Security. Now, Social Security, you're only able to take Social Security out in the future, and the rules is you can take it early at 62, you can take it with current rules now you can take it at 67, and then you can delay it, and then each year you delay it, you receive credits. And so if you wanted to take Social Security, I think I believe at 70 you've already delayed it for 3 years, and you get extra money on a monthly basis. So what if you wanted to retire early though? What if you wanted to retire at age 50, 55, right? And you got your Social Security money in the future. Right here, you would have, if you started now, or if you started investing in your 401k at age 20, 25, 30, you have 30 years, right? Let's just say you have a portfolio of $1.4 million and I already showed you that you're able to take out $63,000 on an annualized basis. But also, what if you also started a dividend growth portfolio? See, for example, right here, I have one of my portfolios going, but let's say right here, my dividend growth portfolio right now is $47,000. I plan on contributing $10,000 per year. It has a dividend yield of 3.45%. And then here's all the other metrics, yada, yada, yada. By me starting my dividend growth portfolio, I actually now have a portfolio of stocks that by me reinvesting itself, that's going to grow. And I don't have to sell the actual shares. See, the 4% rule, you are buying shares of stocks and index funds and mutual funds. But at the end of the day, you have to sell those shares to retrieve the value to get the value or the money from that portfolio. When you are a dividend growth investor, you're able to buy shares and not have to sell those shares, but still reap the value of receiving the income from those stocks, receiving the income from those income or dividends from Home Depot, Lynn, from uh, EPD, Enterprise Products. What else? Lowe's, uh, ARCC, Realty Income, Arbor Realty Trust. So if you have a portfolio that's growing 10% per year, and the dividend growth of the portfolio is growing 9 or 10% a year, you see right here. For me, I start out with a principal of 47,000, but then in 10 years, that 47,000 grows to 307,000. You see that? And then 5 years later, it grows to from 307,000 to 636,000. And then, but also this portfolio is paying me $22,000 per year. And so right here, even just at year 16, 17, if I just wanted to just retire, so within 15 years, I'm 35. If I just wanted to retire, I would have a portfolio that's roughly $600,000 to $750,000, paying me roughly $22,000 to $25,000. And then you have a portfolio from your job that you've been contributing, that you've been letting it grow. And this is also not taking into account Social Security in the future. And also, if you had put money into a Roth IRA, if you put money into a Roth IRA and was growing that portfolio is growing. You're able to take money out the Roth IRA 25, 30 years, 50 years down the line, tax free. And then also right here, you have a portfolio that's growing and 25,000. Imagine you have a side business. Imagine you're a YouTuber. Imagine you got money from your 401k that you're taking out for the 4% rule, 4% on an annualized basis. You have a dividend growth portfolio that's paying you roughly $20,000 to $25,000. That's growing 10% annually every year, and you have a side business or online business. You're set. You're set, whether you want to stay in the US or whether you want to live abroad. So when you think of the 4% rule versus dividend growth investing, why not do both? Why not do both? Why not have dividend growth stocks in your Roth IRA, your regular traditional IRA, and then also invest into your 401k? And then also, why not put some dividend growth stocks and also uh, a VTI or VU in your Roth IRA and grow that? Who said you had to do either or? It's best to leverage and do both to make money, so that basically you grow your Roth IRA, you can pass it down to your family, you can pass it down to your children. So think about it. The retirement strategy of the 4% rule, create a dividend growth portfolio is all beneficial. Start now. The best time to start investing was yesterday. The next best time is today. So hopefully you guys enjoyed the comparison of me showing you how much money you can make just investing into your work 401k, and how to apply the 4% rule to your work 401k, but also creating a dividend growth portfolio, growing your dividend growth portfolio and living off the dividend. And if you want to learn how to create a dividend growth portfolio, I'm going to make another video about that, and hopefully you guys are able to learn and absorb some of this game. Hope you guys enjoy your day. Peace.